Welcome to the deep dive. Okay, today we're tackling something really key for anyone trading nifty options.
Yeah.
Are those premiums, are they sometimes just too high?
Uh-huh. A really common question.
Exactly.
Yeah.
We've looked into it, and we want to give you a straightforward way to figure out if an option's overpriced. Helps you avoid overpaying, make smarter trades.
Right. It's more than just looking at that price tag. We're talking about a step-by-step check.
Perfect. So let's dive in. Step one is just understanding the premium itself, right? It's the cost, the price you pay for the option contract.
Yeah, the right to buy or sell Nifty at a set price, the strike price, before it expires. Simple as that.
So imagine Nifty's hovering around, say, 22,000.
Yeah.
And you see a 22,100 call option going for, I don't know, 150 premium. The big question is that 150 rupees fair or too much?
That's the core issue.
Mm.
And that leads straight into step two, breaking that premium down. You need to look at its intrinsic value and its time value.
Okay, intrinsic value. That's the immediate value if you exercised it right now.
Exactly. For a call option, if Nifty's higher than the strike price, the difference is intrinsic value. So if Nifty's 22,000 and the strike is 21,800, that's 200 intrinsic value.
Makes sense.
And for a put, it's the other way around if the strike is higher than Nifty. A 22,200 put when Nifty's 22,000 also has 200 intrinsic value.
But crucially, for our example, that 22,100 call, when Nifty's 22,000, it's out of the money. So
Zero intrinsic value, which means that entire 150 premium is purely time value.
right. And why is separating those two so important? Why focus on time value?
Well, because time value is where expectations live. It's the market betting on how much the price might move before expiry, plus the decay over time itself. If that time value seems unusually high compared to, say, other similar options, that could mean it's inflated. Maybe the market's expecting huge swings, or there's just super high demand for that specific option. It's the bit most likely to be overpriced.
Okay, got it. That high time value is a potential warning sign, which I guess brings us to step three, checking implied volatility.
Precisely. 4. That's the market's own forecast of future Nifty swings embedded in the option price. You'll find it on your trading platform, usually.
And what do you do with that IV number?
You compare it. First, compare it to historical volatility, or HV. That's how much Nifty actually moved recently, say, over the last 30 days.
Okay.
So let's say Nifty's HV has been around 15%, but the IV for that 22,100 call option is showing maybe 25%.
Oh, whoa, that's a big jump.
Right. That gap suggests the market is pricing in way more volatility than we've actually seen. Could be overpriced. You should also compare its IV to other options nearby. Same expiry.
Is this one particularly high? Especially for out-of-the-money options. A standout IV is suspicious.
Right. Check against the past and check against its peers. Makes sense. What's step 4?
Step 4 involves looking at the Black-Scholes model. Now, don't worry, you don't need to calculate it yourself usually.
Good.
Think of it as a theoretical fair value calculator. It uses the Nifty price, strike price, time left, interest rates, and crucially, that implied volatility we just talked about. And platforms often show this theoretical price.
Yeah, most good platforms will show you the theoretical or model price next to the actual market price, the premium.
Yeah.
If your 150 premium is way higher than the model's price, say, the model suggests only 120. That's another strong hint it might be overvalued.
Okay, another benchmark. That's helpful. Moving on to step 5,
Mm.
considering market sentiment and events.
Absolutely. Premiums naturally tend to inflate before big, uncertain events. Think major policy announcements, budget day, maybe big corporate earnings if they impact the index. Volatility expectations rise.
So you check the calendar.
You check the calendar. If there's a major event looming, high IV and premiums might be justified. But if things are quiet and yet IV and premiums are sky high, well, that smells more like overpricing.
Anything else under sentiment?
Yeah, maybe glance at the trading volume and open interest for specific strikes. Really unusual spikes in activity, especially on far out of the money options, can sometimes be speculative frenzy pushing prices up temporarily.
Gotcha. Look for the news or lack of news and weird volume spikes. Okay, step 6, comparing across the board.
Yes, compare premiums across different strike prices for the same expiry date. Look for oddities. If a 22,000 call costs 150, but the next strike up, the 22,100 call, costs, say, 140, that step down might seem small relative to the risk change. Or compare different expirations.
How so?
Well, if a call option expiring in 1 month costs only slightly more than a similar one expiring in just 1 week, maybe the near-term option is too expensive or the longer-term one too cheap. Look for pricing that doesn't quite seem logical relative to its neighbors. Anomalies can signal mispricing.
Spotting things that just look off.
Yeah.
Okay. So final step, step 7. Putting it all together using our example. Nifty 22,000, the 22,100 call, 10 days left. Premium is 150.
Right. Let's recap the checks. Step 2, zero intrinsic value. So the full euro 50 is time value. Seems potentially high. Step 3, let's say we found its IV was significantly higher than recent HV. Another flag. Step 4, the Black Skulls model suggested a fair value closer to maybe 120. Flag number 3. Step 5, we checked, and there are no major market-moving events scheduled in the next 10 days.
Uh-huh.
Step 6, maybe comparing it to the 22,200 call or the prior week's expiry showed this one looked a bit expensive relative to others. So you add it all up.
And the verdict on that 150 premium.
Well, it's pretty likely to be overpriced, doesn't it? You might want to avoid buying it, or if you're selling options, it might look attractive to sell.
Yeah, makes sense. It's about systematically using these tools, the option chain on NSE, your trading platform's data, maybe some historical charts to build a case.
Exactly. It equips you, the trader, to make a much more informed judgment call.
It really does. It's about moving beyond just guessing and actually assessing the value you're getting.
Yeah.
So we've laid out these steps, but thinking beyond them for a moment, what other maybe less obvious market dynamics or, I don't know, shifts in trader psychology might cause options to get temporarily mispriced? And how could you perhaps factor those kinds of possibilities into your analysis?
That's a great question to ponder.
Something for you to think about. That wraps up our deep dive for today. Thanks for listening.